Hey traders, Park here with another video on sector rotation. You can see where this week XLK overtook XLE for our runner, for our top leader for the sector rotation on the sectors. While headlines remain obsessed with mega cap technology, capital is quietly rotates beneath the surface. Some sectors are beginning to show strength, others are losing momentum. Oops, let's zoom back into it so we can see some things. You can see IGV is pulling up. You look at the last video, it was red. So some of these sectors are losing momentum, and energy is kind of losing momentum. You can see right here what's the leading sector, but now it's falling below XLK. And a few areas that nobody was talking about a month ago are suddenly attracting serious flows. That's with IGV and a couple of other sectors. Today we're going to break down exactly where institutions are allocating capital, what sectors are leading, which groups are weakening, and what it means for investors going into the next phase of this bull sector. As you can see right here, the VIX kind of pushed up a little bit, but XLK is our leader, our laggers XLF. My last video I said that it's probably going to be pushing up. XLF didn't do anything. We're still waiting on the Fed, but XLK took over. XLE took a backseat to it, and you can see what XLY, XLV are actually coming up. In my last video, I talked about Dell. This is the JETS, is the video ETF for the airlines, and you can see where it's pushing up. Let me zoom out. But Dell did break out. I probably should collapse this to a 3-year time frame versus a 10-year. I was looking at some seasonality plays, but you can see what just broke out, and Delta Airlines also broke out as well. From that last video, I was telling you that Delta Airlines has a potential to break out, especially with the potential with the Middle Eastern oil crisis possibly dying down. And if we were to go to, what was I looking at? The other thing was Dell. Dell had a massive breakout on earnings, kind of sort of the same way AMD had a massive breakout as well. So just flowing into that. So, but let's go back to the SPY. And we can see how the S&P 500 continue to make a new all-time high for this week. And it continues to make higher highs and higher lows. Volatility remains subdued. You can see this. You can see that in the VIX, but it really falling below here. The VIX is holding their historical calm level, suggesting there is no meaningful fear in the market right now. What's interesting is that we're not seeing broad participation equally across every sector. Instead, we're seeing what institutional traders call a high dispersion environment. That means capital is becoming highly selective where it's going to. Money isn't flowing everywhere. It's flowing into particular sectors and specific industry groups. Historically, these environments create some of the best opportunities because leadership becomes very clear. The goal isn't owning everything, it's identifying where the strongest money flows are occurring. Like I mentioned, IGB, you can see where it's here, where it's percent for the years coming up. So IGB is the software, and a lot of times people like to pair software against hardware is XLK. You can see you have this strong volume on this candle as well when it was just lingering down here. As technology still leads, so I'll go to XLK chart now, and you see it's completely broken out as well. This indicator I have on here is the precision range indicator, and it got that breakout right here on 522. And the other indicators on here is my Forex cloud, and this represents a 21-day, 42-day, 63-day, and an 84-day. And this big red line right here represents 200-day, and this dash line represents a 10-day. So it's kind of sort of a momentum average, yeah, for that. So right now, XLK and the semiconductors are really leading everything. Technology remains dominant leadership section over the last 100 trading days. Technology outperformed the S&P 500 by more than 30%, and that's what you can really see on our percent change, sector rotation percent change indicator here. Sector selection matters. Industry group selection matters even more. Inside technology, semiconductors remain the strongest group by far. Semiconductors are up more than 90% on a relative basis. That is extraordinary leadership. Institutional capital continues flowing into AI infrastructure, data centers expansion, network equipment, and high performance computing. As long as semiconductors remain strong, it's difficult to build a bearish case against the broader market. Historically, semiconductors leadership often acts as a leading indicator for risk appetite across the entire market. When semis lead, institutions are typically embracing growth, not avoiding it. And one of the things is, I think it's Taiwan Semiconductor. It's also one of our leading indicators as well for the semiconductor industry. So this is a chart of Taiwan Semiconductors. Let's go back to IGV. But here's where things become interesting. Next rotation may already be underway. While semiconductors remain leaders, software is beginning to reallocate. After months of underperformance, software has broken a key relative resistance level and is beginning to attract fresh capital. This matters because software is one of the largest industry groups in the market. When software and semiconductors lead together, market breadth tends to improve. We're also seeing renewed strength in computer hardware. Recent earnings from companies exposed to AI infrastructure have triggered massive breakouts. Institutional money appears to be broadening beyond pure semiconductor exposure and moving into the next layer of AI ecosystem. Suggests that AI trade is maturing rather than ending. Capital is expanding into adjacent beneficiaries. I'm going to push this over to a weekly chart, and I'm going to look at some of the other software names that I have been following. And you can see where this is the precision range indicator, so you can see where it made a 50% retracement. And you can see it line up perfectly with my fields as well. And it's pushing up, but it gives you a caution sign just because volume. This range is above average. The high-low range is above average, but the volume is below average. So one of the ones I was following that I found peculiar was Unity stock software. It completely bucked the market, at least in my opinion. It had this bad collapse back here in for February. It collapsed after earnings, or before earnings actually, but it was holding up compared to some of the other software names. So let me go to, it was holding up better than some of the other software names I had seen, especially when you came to look at now. It's pushing above and it's holding what is it, 124 now. And if you look right here, I think it's 128 now. So this is oil. You can see it spiked this evening, 5 o'clock. This is the futures, NASDAQ, futures, S&P, and futures small cap. But I was looking at now, and just waiting for it to pop up. And yeah, this is the 30. No, that's the 29th. So after hours, it pushed up, and it's continuing to push. One of the reasons why it's pushing up is because the CEO was buying the stock as well. He really believes in his company. I'm trying to think of another one. What is it? ORCL, Oracle is another software. You can see it's breaking out. It was really in the dumps down here, and really what you're looking at, keep hitting the same level here and really couldn't break down any further. That's basically just people accumulating the stock, and it's busting out right here now. This area of resistance, so it could find resistance here. But those are just some of the software names there. Let's go back to the IWM. I wanted to look at small caps. Small caps breaking out as well. It broke out here on the 26th. Another bullish development is participation from small caps and transports. Small caps have struggled for years under high interest rates, but as treasury yields have pulled back, small caps performance has improved dramatically. The relationship is straightforward. Lower yields reduce financial pressure and improves future earnings expectations. Meanwhile, transports continue showing relative strength. This is important because transportation stocks often reflect real economy activity. When transports outperform, they're effectively confirming stronger economic expectations. Together, small caps and transports suggest this rally is becoming healthier beneath the surface. So this is small caps. XTN is our transports. And you see it had this huge push right here along with everything else in April. And it had a pullback, got back above its 50% retracement, and it's pushing back above as well. Now, some of the weakening areas is XLE, XLF. Those are more considered the defensive sectors. So XLE, I'm not gonna rule out really because all this data center stuff, it needs energy. So it's really gonna be selective energy stocks that are gonna be moving forward in this energy sector. So it's not gonna be continually thrown away. And some of the energy stocks have become sleepy. One of the ones I was looking at was Constellation Energy. I think it's CNG. What is Constellation Energy? CEG was one of the ones I was looking at, and you can see where it kind of fell, and you can see where it's in this consolidation phase right here. It just had earnings, it collapsed on earnings, but some of the other ones I was looking at is, I think it's NNE, Nano Nuclear. Some of the nuclear names, NEE was, I think, those. So you can see some of the energy stocks have taken a backseat or are pulling back now. But you can still find some of the ones that are going to really be supplying energy for these data centers. One of the more speculative plays is XMR. And it really had a fall in OKLO, OKLO. BE. I'm trying to think of some other ones, but those are some of the ones that's gonna. I'm not discounting, or I'm not getting rid of XLE. It's just pulling back as far as I can see. But because of the massive amount of power that the data centers need, you're still gonna be able to find some plays. Energy has been one of the biggest losers recently. Declining crude oil prices has significantly weakened the sector. Institutional investors are reducing exposure as inflation expectation and cool and commodity momentum slows. Financials also remain a concern. So let's go look at XLF. Many investors assume rising rates automatically benefit banks. In reality, yield curves structure matters far more than the headlines rates. The financial sector continues to lag the broader market. Defensive sectors are also weakening. Utilities, consumer staples, and real estate. These are classic risk-off areas. The fact that they underperform tells us institutions are still prioritizing growth and cyclical exposure over defense. And we can see that really in our sector rotation here. So you can find any of those areas that we just mentioned, especially when it comes to they're all in here in the lagging area. So you got utilities, XLU, you have where's real estate, XLRE, real estate, and then you have consumer staples, XLP, or whichever one it is. Well, just looking at it, technology is number 1, energy is number 2, materials is number 3, industrial is number 4, real estate is number 5, and staples, XLP, is number 6, utilities is number 7, discretionary, consumer discretionary is number 8, communication is number 9, healthcare is number 10, and financials is 11, and so on. So those are some of the underperforming sectors right now. XLB, excuse me, where's material sector right here. One of the most interesting developments is the strength emerging in materials, particularly the steel industrial infrastructure companies. The market narrative focuses heavily on AI chips with massive data centers. Construction requires enormous amounts of physical infrastructure, steel power systems, electrical equipment, and industrial components. This isn't the primary AI trade. It's a secondary order effect, and secondary order beneficiaries often where institutions look once and obvious winners become crowded. So let's go look at XLB. XLB. And you can see where it's kind of trading within this range. It really pushed up here in January, and it really just found its top here in what is it, February, and it came down, had this pullback to March, and then it's pushed up, but it's kind of been this consolidation phase ever since March 23rd here. But it's because all this materials and everything is going to be needed for these AI sectors and everything, and you probably see it's going up as well. So next, let's go look back at our sector rotation indicator. Going forward, there are three key signals I'm watching. First, can software continue gaining relative strength versus semiconductors? Second, do small caps continue outperforming as yield decline? And third, can materials and industrial infrastructure stocks attract sustained institutional capital? If those three trends continue simultaneously, the bull market broadens, and broader participation typically extends market advances. If instead we see semiconductors weaken while these groups fail to take leadership, market risk rises. So that's one of the things that I'm going to be watching, I guess, for this week or this really coming up. One of the things I like to do also is take my sector rotation indicator and put it on this second quarter. Second quarter starts with the month of April, and I'm going to put it on the first day of April, and we're going to get a different picture of our sector rotation, but it's going to give us a picture of what's going on since the second quarter started. So this is what happened in our second quarter. So XLK, you can see it's the leadership, it's the top performer. Since the start of the fourth quarter, April, XLK is up 43%. Discretionary is behind it. Real estate is second. Industrials is fourth. Financials is fifth. Communication is sixth. Materials, healthcare, staples, so on and so forth. But this is another way of looking what's going on since the fourth quarter started, and where can we find some more leaders, and where can we expect things to be going. And this is really shows just the improvement since the fourth quarter started. So, but we're on our scale shows extreme greed. But the biggest takeaway isn't that technology is leading. Everyone already knows that. The real story here is where leadership is expanding next. Software is improving, small caps are participating, transports are confirming, materials is emerging, and institutions appear to be rotating rather than exiting. In bull markets, money rarely leaves the market. It simply moves to the next opportunity. The investors who identify that rotation early are usually ones who outperform. If you enjoyed this analysis, subscribe for weekly institutional sector rotation updates, and I'll see you in the next video. I appreciate you guys taking the time to listen to what I had to say. I wish you the best. Stay safe out there, and God bless.